going to cover the professional standards and maybe touch on independence. We'll get to at least start on the chapter on independence, which is module B. When we talk, I know I mentioned this when we just in the introduction of the reports that the auditors follow generally accepted auditing standards. And so what generally accepted auditing standards are those standards that covers, and we'll go into this in detail in a moment, covers the auditor's responsibilities, performance responsibilities, meaning those standards that adhere to the actual audit engagement, and standards of reporting, which deals with the reports that auditors issue after they collect evidence on the client's financial statements. A couple of things that I want to point out before, because this is going to be important as you go through the cases, as you complete your cases. So when we talk, we have standards that are issued by the AICPA, or the Auditing Standards Board, which is generally referred to as Statement on Auditing Standards. Those standards were the standards that were in existence and continues to exist, but were in existence prior to Sarbanes-Oxley and prior to the formation of the PCAOB. So what the PCAOB standards cover are their standards related to audits of publicly held companies. So the Apples, the GE, so companies that are traded on the stock exchange. If the public can purchase stock in a company because the company is traded on the stock exchange, those companies, those audits are going to be covered by the PCAOB standards, which you see referred to as AS, Auditing Standards. So auditors have to follow those standards. If they're auditing a publicly held company, they follow the PCAOB standards. If there isn't an applicable PCAOB standard, they then follow Statement on Auditing Standards. So auditors have to, adhere to both sets of standards. And then for privately held clients, meaning clients that are not trading on any public exchanges, they follow the AICPA standard statements on auditing standards. So when we talk about standards, I tend to default to the PCAOB standards unless there isn't an applicable PCAOB standards, then I'll refer to it as Statement on Auditing Standards. So for example, one of the first things that the PCAOB did when they issued standards was to issue standards on the risk assessment process and then the response to that risk assessment. So the Statement on Auditing Standards always has standards on risk. The PCAOB enhanced the standards. And so their standards were somewhat more detailed and explicit. So there's a whole suite of standards on risk assessment. I think it's AS12. I can't remember the exact number, right? So when we talk about risk assessment, we'll talk about that from the perspective of the PCAOB standards, the AS standards. When we talk about fraud, the PCAOB hasn't issued any standards on fraud yet. So we're still following this standard, the Statement on Auditing Standards, which is SAS 99, fraud risk assessment, auditor's responsibilities related to fraud. Okay, so we will go back and forth. So it's important to note that make the distinction. But in most cases, unless there isn't a PCAOB standard, I'm going to refer to the PCAOB standards. And when you're doing your cases, I'm going to tell you it's a publicly held company, and then you should know to look first at the PCAOB standards, and then if there's not an applicable standard, then look to the Statement on Auditing Standards. Okay, so everyone get that distinction? Okay. Okay, so as I said, generally accepted accounting standards and principles cover three areas: responsibilities, performance, and reporting. So responsibilities, as I said, relates to auditors, the individual auditor, the audit team. The performance relates to the standards governing the actual audit engagement. And then the reporting standards relate to the audit reports that are issued. So in all, under these three categories, there are about 10 general standards. So let's talk about responsibilities first. So before we go into that, but I just want to make sure that as we go through the semester, and especially as we start to get into the evidence collection, audit procedures related to evidence collection, audit procedures related to the audit report, it's important to keep in mind that auditors are providing reasonable assurance. And we talked about this a little bit earlier. They're not providing absolute assurance. Why is that? What's the distinction there? Why is it that auditors cannot provide absolute assurance? Yes?
I'm sure.
Okay, thanks.
But, well, I mean, because if you're looking at a company with a lot of transactions, like thousands and thousands of them, there's no way that you can go through each transaction and audit each and every one of them.
Right.
So you can only sort of like attest for the material part of the transactions.
Right, so, very good. So because there's no way possible that auditors could look at 100% of the transactions, they couldn't possibly provide absolute assurance. The other component to that is, remember, we talked about this, especially when we talked about professional judgment. There are aspects of the Generally Accepted Accounting Principles that has a very subjective element to it, such as the allowance for doubtful accounts, the obsolescence reserve, fair value measurement. Right? Those are estimates. So that means that your estimate could be quite different from my estimate based on how we view the evidence, right? Or how we view or frame the problem. So if we have elements in the financial statements that have a level of subjectivity in it, it's not feasible that auditors can say with absolute assurance that that number is correct. Right? They can't say that. They can say it's reasonable based on the audit procedures that they perform and the evidence that they gather. So they can only provide reasonable assurance. And what this is so important is stated right in the report, the auditor's report, so that it's clearly communicated to readers of the report that auditors are not providing absolute assurance. It's reasonable assurance. The other key element is this idea, this concept of materiality. And we'll cover materiality in a couple of weeks. But the financial statements are free of material misstatements, right? Because think about what materiality means. It's, again, a very subjective concept, right? Because what is material to you might not be material to me. So let's just think about the case that we went through with Rosie's restaurant. And there was a difference of about 75 cents or 80 cents, I don't remember which, right? Some people thought that meant something to some people. It meant enough to them that they would contest the bill. Some people, it's like, it's just not that, it's not such a big deal to me, so I'll, just waive it and go ahead and pay the bill. Well, we don't, what you think is material, so it's hard to come up with a number that really reflects materiality that would be considered material to everyone who uses the financial statement. So when we talk about how auditors determine materiality, we'll talk about the guidelines that they use. And the guidelines that they use is based on a reasonable user of the financial statements, because there's no way possible that they can know what's material to every single user of the financial statements, because they don't know who those users are. And they don't know what their preferences are. So the idea is to that the report tries to communicate is that the financial statements are free of material misstatements, and we'll talk about some of the guidelines of that. So when we talk about the report, we'll talk a little bit more about the communications. basic standards that fall under the three categories: responsibilities, performance, and reporting. So the first set of standards relate to those responsibilities of the auditor or the audit team. So you'll see things such as training and proficiency. Right? A car mechanic cannot go out and conduct an audit unless they have training and proficiency in conducting an audit. Right? That's why you're sitting here. That's why you're taking all of the required courses so that you're able to get a job, and then you're going to sit the CPA exam, maybe, and pass the CPA exam, right? And even after you do that, you have to have what we call continuing professional education, right? So it's constant training and development so that you are proficient at auditing and accounting. Independence and mental attitude. What does that mean to you? What does that say? When you read independence and mental attitude, what does that mean? How do you interpret that? Yes?
That you can't be influenced by maybe any parties, like let's say your father works at a company, you have to have independence and not audit that company.
Okay. Anybody else? AJ? Okay. Anybody else?
It's just like thinking for yourself and not just buying into what anyone says.
Okay. So all of those are good, examples of independence. But independence, what Anna described is actually independence in appearance, right? Because the standards very clearly indicate that if your relative, a close relative, and we'll talk about those more when we come to independence, has influence over the financial statements, or preparation or influence over the financial statements, that you can't audit that company. You can't be the lead associated with that audit, because that would possibly impair your independence. You might say, I don't care, I'm gonna use your father. I don't care, I'm gonna give my father the hardest time, even harder time than if it was a third party. You can't have the appearance of there being an impairment of your independence. So that's specifically covered by Rule 101. Rule 101 says you can't do that. That's independence and appearance. Independence and mental attitude kind of gets more at what Stefan pointed out, AJ pointed out, professional skepticism, unbiased, that you're approaching this audit with a mindset of objectivity, right? And that's harder to regulate. You can say you have the independence and mental attitude, it is extremely important, but it's harder to regulate because sometimes you hear independence and mental attitude is independence in fact. That because you as the auditor are the only one who really knows if you are viewing this audit objectively, if you're making decisions based on objective information, if you're making decisions that are not influenced by your own personal incentives. Only the auditor knows that. When we find out about impairment of independence and mental attitude or independence in fact, we usually find out after the fact. Right? Someone goes in and says, for example, the PCAOB or the SEC and says, you know what, you made a bad decision, right? Or you didn't make the best decision. And so and we think you didn't do that because you violated your independence. Your independence was impaired because this is a significant client, you wanted to keep the client, so you allowed yourself to be swayed by the client's perception, by the client's opinion. You were motivated to accept the client's position, right? And the auditor can argue, no, that's not the case. I really thought that this was the right answer. But most times you're only going to hear about auditors impairing or being perceived to impair their independence in mental attitude or independence in fact after something happens, right? After someone comes in, because an auditor is certainly not going to say, oh gosh, I impaired my independence in fact. That's not what's gonna happen, right? So when we talked about professional judgment, that's why professional judgment is so important. Right? That's why thinking through, making sure you clarify the problem and the objectives so that you're approaching the solution to that problem in an unbiased manner. So that you're not letting taking mental shortcuts or being trapped by judgment biases that would result in less than effective judgments. Right? Because you really do have to guard against independence and impairing your independence in fact. Some things that regulators do try to do to address this to the extent that they can, and when we talk about independence we'll go into more detail, but rotating. The partner, the engagement partner has to rotate on the audit after 5 years. Things like the review process. The review process is something that's really important. So if you an independent review process in firms, they'll have what they call a technical review partner. So that technical review partner will hopefully mitigate these types of problems where you might have an auditor unconsciously biasing their judgments in favor of the client. So you have that peer review process. Yes, Mom.
Do these technical review partners also rotate off clients like partners do?
Well, there's not a requirement they have to, but I would imagine as a part of the firm's quality control that might be the case. And some, because of the new rulings, that engagement partners have to rotate off after 5 years. Because that can be a shock to a client in terms of just the amount of knowledge that engagement partner has, and then also the relationship that they have with the client. So what some firms do, well, I think what all firms do is they have what they call this transition process, right? So that they are succession planning. So that it's not such a shock to the client at the end of 5 years, this partner rolls off and a new one rolls on. And in some cases, that person could be the technical review partner because the technical review partner has no engagement responsibility at all, except to review, to provide a higher level review. So some firms, and I'm not a part of any firm, so I'm telling you this just based on my understanding when talking to the partners.
You mentioned from the reading that independence is impaired if the auditor has a direct or close family member who owns like a high percent of the stock.
Yeah.
So what happens if the auditor is already in process, but a family member acquires stock later on after it's issued?
So you mean, but the audit is still going on?
Yeah.
So first of all, if you're on the audit, you're going to know if the company's in the process of being purchased or selling shares. And if it's a close family member, I would argue that you would probably know that. You would have to communicate that right away to the firm higher ups, and you'll be removed from the audit. You know, I mean, they're not going to firms are not going to risk violating their independence. I mean, there's certainly things like independence and, that a violation of Rule 101 is just, that's that low, that's that 0-1. Did you do it? Did you not do it? Do you have a family member with ownership or not? So that's Rule 101 is very objective. There's no subjectivity really around Rule 101 for the most part. There's a lot more judgment around mental, right? Independence and mental attitude, because you have to kind of get in someone's head or look at the results after the fact and draw a conclusion about it. So I would say that that person would be responsible for alerting the firm right away, and they probably be removed from the audit. But also the audit committee has a responsibility. When we talk about the publicly held companies anyway, the audit committee has a responsibility to ensure that they're comfortable that the firm, the audit firm that they hire, is independent, indeed independent. So the other standard is due professional care, and so and that goes without saying, right? That you approach this audit with a level of objectivity, that you ensure that you are conducting so that you're putting in the necessary time and effort to complete the audit. That you, for example, you understand, you have expertise, for example, in that area, or at least you have staff people or audit team members who have the ability to conduct the audit. That you're going to approach the audit, you're just not going to go out to the client and sit out at the client, right? That you're mindful of what your responsibilities are, maintaining professional skepticism and professional judgment, recognizing that gap in some instances is not black or white, and there's a great deal of judgment that auditors must bring to an audit engagement, and so that they're applying an appropriate level of professional skepticism. So we talked about this briefly, independence of fact and independence of appearance, and we'll cover this in more detail when we talk about independence. That you, when you talk about due care, as I said before, that you're bringing the same level of diligence to an audit that you would expect from another audit, right? That there is, and that's a part of the standards, is thinking through how would someone else approach this. Remember when we talked about judgment, would a reasonable auditor perform the same way in similar circumstances? Skepticism, we're going to talk about it in a lot more detail next week, but it's a questioning mind, trust but verify, right? And so recognizing, so when we talk about risk assessment, we'll also talk, give some more concrete examples of where auditors are expected to really bring professional skepticism to bear. So part of that is understanding your client, and for example, understanding where the client might have incentives, whether the client might have incentives to mistake the financial statement. So that's not saying, and one of the things we say, you don't want to assume that your client is dishonest, but you don't want to have this blanket acceptance that you'll never do anything wrong. So it's trust but verify, have a questioning mind. And we talked about judgment last week. So those were responsibilities. So again, think about responsibilities of those things that are characteristics that the auditor should have, that the audit team should bring to the audit. Independence, due professional care, proficiency, training. Then there are standards of fieldwork, performance standards. And that deals with standards related to the audit engagement, the actual carrying out of the audit engagement, the evidence collection process. So standards of fieldwork says the job should be planned and supervised. You can't just show up, oh my gosh, we're supposed to start this audit, let's go. Right? You can't just show up. You have to plan the job. You have to make sure that there's appropriate supervision. Right? So planning the job, we'll talk also, that's the key phase, and one of the key phases in the audit. Understanding the client. What's going on with that client's industry? How's the current economic situation impacting our client? So let's think about a client that let's think about a client like Home Depot. What kinds of things can impact Home Depot? Home Depot, right? It's a home improvement store, right? That people go there to buy built-in materials, things, materials. You have everyone from professional contractors to, everyday Joe who just like, oh, I want to try to do it myself, kind of do it yourself and fix my, bathroom or something to renovate my bathroom. So you have a wide variety of types of customer bases, right? So if you think about just from a consumer standpoint, right, if we have a dip in the economy or the housing market, that's going to have an impact on Home Depot, right? It could go from having a significant impact, depending on if it's in a particular, if it's widespread like we saw in 2008, the housing crisis, or it might be regional, right? That there's certain states where there's a housing crisis, or certain states that are not rebounding from the 2008. How does that affect your client? So it's planning, and I'm using this as an example because planning involves knowing not only the client's internal environment, but the external environment and how that impacts the client, the financial statements. Supervision goes without saying, you have to supervise. Understanding the entity and its environment so you can assess risk, and that's given the example with Home Depot, right? So where would the risk be? How would that, so, and also remember we talked about, a part of planning is looking at last year's financial statements and comparing it to, information in the current year financial statements. So you really need to understand what's going on with the entity to be able to identify where there are problems. So again, attention directed. So the planning phase is really how we're going to conduct this audit. And you also, what's important with the planning phase is you need to know, you might need to identify, well, if the client has unusual transactions that they didn't have in the past prior years, maybe I need to bring on a specialist, right? Because I don't have the expertise to from an audit perspective do that. What if the client implemented some new IT system that's all encompassing, so it's very complicated? Well, then you need to bring in an IT, have an IT audit person, or have IT go in ahead of the year-end audit to look at their IT systems. So that's the important thing there, is understanding where you're going to direct your resources based on your planning assessment. And then obtaining sufficient and appropriate audit evidence. So sufficient audit evidence is, deals with the quantity of evidence, and appropriate evidence deals with the quality of that evidence. It has to be relevant and reliable. We'll cover that in more detail as we talk about evidence. Because your evidence has to support your audit opinion. Right, so when a regulator comes in, PCAOB or they want to know how you arrived at this opinion. Why did you arrive at that opinion? What are they going to look at? They're going to look at your audit work paper, right, as evidence for the evidence that you collected. And your evidence should support your judgments. Remember when we were talking about the judgment framework, you have to be able to support the judgments that you made. That's why you want to approach your judgments in a logical, rational fashion. That's why it's so important to document. I should be able to pick up the work papers and understand how you arrived at that judgment. I may not agree with it, but I should be able to understand how you got there. Right? I should be able to understand your inputs and the assumptions that you made, and I can take a step back and say whether or not I agree with those or I thought they were reasonable. You should be able to support it. So what did we say about high quality judgments? What are two factors?
Consistency.
Yep, consistency is one. And confidence, right? Consistency that you would make, given the same set of facts, you would make the same judgment, and confidence in that judgment because you have to be able to defend your judgment in the case that you are called upon to do that. Okay. I already talked about reasonable assurance. Reasonable assurance of financial statements are free of material misstatements. The planning and supervision deals with the audit plan that tells you how much you have to, how much time you have to spend on the audit, what resources you have to direct it, that audit, whether you need specialists on that audit, if there are any significant changes. Okay. Materiality. Again, materiality in a nutshell basically says what is going to influence the decision of a reasonable user of the financial statements. And we'll talk about how we arrive at materiality. And it's something that is ongoing throughout the audit. We're going to spend a lot of time talking about risk assessment. Both risk assessment at the planning stage and in particular fraud risk assessment, the audit risk model. Remember I said that the audit is a risk-based audit. So we assess the risk, and based on that assessment of the risk of material misstatement is how we determine the nature, timing, and extent of the audit procedures that we're going to perform. So the risk assessment process in the planning stage is extremely important. And then, as I said, audit evidence, that's your sufficiency, the quantity of that evidence, as well as the quality of that evidence. So in most cases, there is the thought process that third-party evidence is probably better, but then you have to also look at the source of that third-party evidence. The other thing is you can't just perform an audit with third-party evidence. It's not possible. So you look at, you're going to have to use internal evidence. For example, if you're looking at the reserves, right? The allowance for doubtful accounts or the obsolescence reserve. That's client generated. You're not going to go with a third party. It's not necessarily provide evidence about the allowance for doubtful accounts. The client's estimate of the allowance for doubtful accounts. So you look, in those cases, you look for things like the controls over that process to determine whether or not you can rely on it. So you're going to be, audit evidence is going to be both internal and external. Then finally, the remaining standards relate to the report. So the audit report is that one page that you see in front of the financial statements, and that's the bang of the buck. That's what people are going to look at, and most times they're going to go down to the last paragraph to see if the auditor issued a clean opinion. So a clean opinion is one in which the auditor gives them thumbs up. They approve financial statements, free of material misstatements, and the audit is performed in accordance with Generally Accepted Auditing Standards. So the reporting standards, which we'll cover toward the end of the semester, deals with the different types of reports that auditors should issue. What are the conditions under which they issue the various types of reports? So the most standard report is what we call an unqualified opinion or a clean opinion. And so when we cover this, we'll talk about what constitutes, what is going to be advised to the auditor giving that type of opinion. You also want to, the standards talk about the wording that should be in the report, like the key elements that should be reflected in all audit reports, the standards. So basically, the auditor is expressing an opinion on the financial statements, or not. Then that's a disclaimer opinion. They have to be able to say, express an opinion or we can. And that is in conformity with whatever the framework is. In our case, it's Generally Accepted Accounting Principles of the U.S. So this standard deals with, these standards deal with the reporting framework, financial reporting framework. So the major items in the auditor's report is that the auditors state right in front of the report, the financial statements are the responsibility of management. It is important for users to know that auditors do not prepare the financial statements. They audit the financial statements. The preparation of the financial statements, the amounts that are reported in the financial statements are the responsibility of management. It's a publicly held company. We're going to refer to the fact that the audit is conducted in accordance with PCAOB standards. Company. The report is also going to include an opinion on the financial statements. That's what people want to see. The opinion on the financial statements, and for publicly held companies, the auditors now have to issue an opinion on internal controls over financial reporting. And we'll cover that in more detail when we get to audit reports, but they can issue a consolidated report, an integrated report is what the term is. That integrated report includes both the report on the financial statements as well as a report on internal controls of financial reporting, or they can issue two separate reports. The auditor's discretion, management's discretion. So these are the important elements of the reports for difference with a privately held company that's not traded on the stock exchange is there's not going to be an opinion on internal controls, or there's no mandate, there's no requirement that the auditors issue an opinion on internal controls, and the audit would be conducted in accordance with generally accepted auditing standards. Okay? So those are the major elements of GAAS. So let's recap. Quick couple of knowledge check questions. So how many people think A? What about B? What about C? So that means the majority of people think D. Okay. So I'm glad you realized that A, because the standards clearly say you can do professional care, right? So let's talk about independence and fairness and independence. Why do you think either one of those are not related to ethical requirements? Those people who said B or C. Why would that not be? I know I saw at least 3 or 4 hands.
So I said C because they could actually be, I don't know how to phrase this. Okay, so they could actually be independent, but they could know somebody for the company, or they could not know somebody for the company, but not act independently.
Okay, I'm a little confused. So
What does that mean?
you're saying they could be independent, but so the C is independent in fact, so they could be unbiased, but because they know somebody.
Yeah.
Right. So let's that's something I want to touch on. You can know people in a company, right? The key is that person, right? Is that person involved in the financial reporting process? Do they have a significant role or control over that process? And what's your relationship? So there's nothing in the standards when we'll go into 101 in a moment, but there's nothing in the standards that say your friend can't work for a client. Right? There's nothing that says that. It talks about covered members and close members. Now, that could be a concern, that is this your best friend and so forth, and that person has a role, a significant role in financial reporting. That might be a concern that you have to be on guard to really guard against your, allowing your own personal relationship to impact. But there's nothing in Rule 101 that prohibits that. So what about, but we'll talk about that more. I'm glad you brought that point up, because that, those are some things that are not prohibited by Rule 101, but our instinct says that, well, that might not be cool, right? To be in charge of an audit where your friend is, have a significant role in the company. All right, what about, I think some people said B. Who said B?
I said D.
D. Who said B? I know I saw a hand go. On it. Come on, that's how we learn. You want to tell me your reasoning now so you don't get it wrong on the exam. So there's no confidence in that decision, huh? Well, B for the same reason, right? Let's just go B and C. Independence is about ethics. Right? It's unethical if you, as an auditor, violate. You're being unethical. One, if in independence and appearance, the standards say that you cannot do it. So if you knowingly violate your independence, right, then you're being unethical. You're not adhering to the ethical code of the profession. Right? So those two are definitely going to be related to ethics. The expectation that auditors present themselves and behave in an ethical manner Professional judgment. So the answer is D, right? While it's important to exercise professional judgment, of course it's it's not a part of, it's not a part of the ethical requirements of auditors. And I get that, our instinct is that it should be. But it's not. I mean, you're expected by, if you exercise due professional care, if you are independent in both fact and appearance, right, that you make good, you will at least be better positioned to make good judgments, right, good professional judgments. But it's not, of the three, of the four, it's the least tied to ethics.
You're saying for ethical requirements, this is ties with the ethical standards or the standards, is that where it's like, it seems like you took care of the
Yes.
that side.
Right. So professional judgment is something we expect you to exercise, right? I mean, we went through the judgment framework, and it's not, and also, obviously, if you're knowingly violating something, it's so you had the right professional judgment, you just decided you arrived at the right judgment, you just decided to not adhere to it, right? So that's unethical, but that's not that you didn't have good professional judgment, that's just that you didn't exercise, you exercised good professional judgment, but you just didn't act on it. Like, that's unethical. But people could have, make a bad judgment, and it's unknowingly. Remember, we talked about the judgment biases and mental shortcuts. That's why it's so important for auditors to be trained, for individuals to be trained to think about how they approach making judgments and try to make them aware of those kinds of things that could negatively impact their judgment. Any questions on that? All right, let's do roll call. Independence. So you're gonna ace independence on the exam, I know. Okay. Why do you think independence? Why is that not related to the standard of due care? Least related.
Because everything else is more related to, you need to verify facts, you need to,
So independence in fact, right, that's a part of me, because remember, and this will be clear to you when we go through independence, but independence in fact is how you are approaching that audit. It's independence in mental attitude. What are you being unbiased when you approach that audit? Are your decisions based on the facts that are presented to you? Are you evaluating those facts objectively? So that's a part of due care, right? It being independent in fact, being independent in mental attitude. What about B? Does everyone agree that B? I don't think that's what you get to B. So yeah, professional skepticism is an important part of due care, right? This is for the same reasons that I just talked about with independence in fact. That you come with a questioning mind, trust but verify. That's a unique part of the audit that you have to bring to bear to exercise your professional care. Why would a prudent audit? I saw a lot of hands go up to C. So why do you think a prudent auditor is not associated with due care? Now, there were a lot of hands up for C, so. Yes.
I guess like for a prudent auditor, I think of like someone that like rushes to like get something done. So then that go along with like the rush to solve, which could be a problem where you don't put enough thought into what's the right
So
question.
you're thinking of a prudent auditor as being someone who is efficient,
Yeah.
right? So they get through things. But a prudent auditor means actually you're more effective as an auditor, right? That remember, it's thinking, a prudent auditor is someone who is kind of approaching the audit, with more caution. They're thinking through. So in your description, if you view a prudent auditor as someone who's more efficient, right? You're thinking of it from an efficiency standpoint, perhaps, right? Because you should be rushing through an audit. Right? Remember, time pressure is one of those things that cause auditors to make a less effective judgment. But in this case, prudent auditor refers to someone who is approaching the audit with more due care, right? They're more thoughtful about what they're doing. So then in that case, that would be associated with. And so what's left is reasonable assurance. But even a way to approach this is here. These first three are characteristics of the auditor, right? They're characteristics of the auditor. Whereas reasonable assurance is a characteristic of the audit. The auditor provides reasonable assurance. It's the opinion that the auditor gives, or the audit firm gives on the financial statements. So when you think about this, right? Due care requires a level of skill and knowledge of others in the auditor's profession, which would include independence and fact. Due care requires the skills and knowledge of others in the audit profession, which include professional skepticism. Talked about a prudent auditor, but reasonable assurance is related to the auditor's responsibility for detecting material misstatements. Right? It's about the audit process. Whereas the other three are about the auditor, characteristics that you expect the auditor to have. So when you're approaching it, so like I try to do knowledge checks, especially with multiple choice questions, because I want to help you think through these things. So when you see, the first time you get an exam and you see multiple choice questions, it gives you a way to kind of approach it to help you to make a better, answer the question, have a better success rate in answering the question correctly. Any questions about those two? The last two. Make sense? Okay, so let's wrap this up then. So in terms of the engagement overview of principles, right? Where you have more or less the phases of the auditor goes out, obtains or retains the client, right? And once they retain or obtain the client, they go through the engagement planning process, and that's the planning and supervision, understanding the client's entity, that kind of stuff, right? Knowing what to expect in this particular client. The risk assessment process, and the risk assessment process is the process of identifying where the financial statements is there more susceptibility to risk material mistake, more susceptibility to fraud risk. And so it's going through the process of identifying the risky aspects of that client. Obtaining audit evidence to address that, that's your response to your risk assessment, and then reporting on the results of your audit, the collection of audit evidence. So if you look at this along the principles, you see that engagement planning, risk assessment, audit evidence reporting are dealing with the responsibilities, professional skepticism, professional judgment, due care. Right? Because at all of these phases, you have to bring, again, these are the characteristics of the auditor, right? Skepticism, judgment, due care. Always these criteria, these factors, these characteristics are extremely important. Performance deals with planning, assessment, audit evidence, right? Because in the planning stage, you're gathering evidence about the client, you're gathering an understanding about the client, both internal, external, what factors internally have changed, what factors internally present a greater risk, what external factors change. So remember we did when we're going through the judgment framework, we had one example, I think it was Fox and Company, where in the current year, the client changed its revenue recognition approach, right? It changed the way they recognize revenue. It had it because, and remember, the senior manager on the engagement did not recognize that change, the impact of that change. And as a result, they performed ineffective audit procedures because they performed same as last year. So it's in this planning process that has a significant impact on the performance of the audit. Risk assessment, the same thing, the amount of evidence collected. And then reporting deals with this standards of reporting. Questions about these standards? So within those standards, so when we start talking about the risk assessment process, we'll talk about standards, unique standards that apply, the specific standards that apply to the risk assessment process, right, that are falling under this performance principle. Okay, just quickly, quality of public accounting firm practices. Firms will have their own. So I told you that for firms that audit publicly held companies, companies traded on the stock exchange, the PCAOB comes in and inspects. I'll talk about that in a moment. But firms have their own quality control standards. So long before Sarbanes-Oxley, PCAOB, firms had a rotation practice. It was up to them what that partner rotation practice was. But they had a practice. They had their own peer review process. They belonged to the AICPA. AICPA had a peer review kind of program, right? The firm, so in other words, KPMG might go out to Deloitte Touche and perform a peer review for them, and vice versa. So within the major firms, they belong to this AICPA peer review program, and they went out and they conducted peer reviews. Firms within their own offices conduct. So you might have the New York office go out to the San Francisco office and select a few audits, client engagements, audit engagements, and go out and perform a peer review. So firms have their own quality control. Other things would be monitoring independence. So firms have very detailed independence rules and requirements. So in most cases, from what I understand, firms will have rules that are more stringent than Rule 101. That's how seriously they take independence and fairness. The fact that firms have a judgment framework, most firms have a judgment framework that they're training their staff on is because they're concerned about independence and mental attitude. So your training covers a lot of these areas because that's a part. Your training is a part of the firm's quality control requirement, and obviously you need CPE credits, but it's also a quality control requirement. So it's the firm's responsibility to comply with professional standards, both regulatory and legal requirements, and it's also they want to make sure through their quality control that when they issue a report that it's appropriate under the circumstances. So the technical review partner or the concurring partner review, firms call it different things, but it means the same thing. You have a third party, a partner who is knowledgeable and experienced, not on the day-to-day audit of that client, who comes in and takes a look, takes a step back and review. So what they're looking for is to see, did we collect enough evidence, appropriate and sufficient evidence, to be able to support the opinion that we're giving in the financial statements. They're going to want to look at those things that are considered to be higher risk, greater judgment, to make sure that it complies with the firm's standards. So the idea is to make sure that you don't, blow an opinion, meaning that you issue an incorrect opinion. So the firm's quality control standards are given that, because the reality is that opinion is what people are looking at when they pick up the financial statements. They're looking at that opinion. And that's what that's the assurance that the firm provides with respect to that, those financial statements. So some of the elements of the quality control would be leadership responsibilities within the firm. So tone at the top. What message is the national office sending, or firm top management sending to local offices? And if you think about, let's say the Big Four, just think about the number of offices that they have all over the country as well as all over the world, and trying to make sure that they send a consistent message about audit quality, that everyone gets it. You're dealing in different cultures where things are seen or dealt with quite differently. I remember when, this is an example of being an internal audit, where we had a similar structure in that our audit guidelines were driven from the top. So from our national New York headquarters, right? And everyone, whatever country you were in, whatever state you were in, you had to follow what we called it at the time was the Red Book. But I remember going to different countries, and because of cultural differences and how they dealt with authority, how they dealt with, there was more deference to people in the United States. There was more deference to people in higher level positions. I was an internal auditor for a pharmaceutical company. And so doctors were, in this particular country, were held in the highest esteem. And so those were the kinds of things that they brought in. It was against the culture to give the doctor a check. Like they had when they would have these different types of events for doctors, it was seen as an affront to present the doctor with a check. It was supposed to be you present the doctor with cash. And so for us in the United States, where we don't do business in cash, you have a check because there's a paper trail and so forth and so on. This was a significant issue a finding for us on the audit engagement, but we had to try to balance that with culture, like the cultural aspects of it, because those types of things they saw as being, inhibiting their ability to drive business, right? So you have to, firms, and I say that to give an example of how you can have a particular viewpoint, and you're here in the States and you're driving from your national office here in the States, but you have to also consider how cultural differences will impact the types of control mechanisms you set in place, and have something to do with that, to recognize that in developing your quality control standards. Obviously, the firm has to ensure that their employees are adhering to the relevant ethical requirements. I talked about the fact that a lot of firms have much more stringent independence requirements than the standards even call for. Right? So they're being in that case, more conservative. And so it's something that, it's something that they have in place to ensure that they're trying to catch a situation where you're out at a client and this client is about to be purchased, and it's about to be purchased by a company that your brother is the CFO. Right? That there's appropriate quality control procedures in place for accepting and continuing client relations and specific engagements. And we'll talk about client acceptance and continuous decisions. We'll get into this a little bit more. But firms will do background checks on the clients, right? If they're going to bid on a new client, they want to talk to other people in the business community that dealt with that client. They want to, because you don't want to know that you're in bed with a client that lacks integrity when it blows up in your face, right? When you're being you now become a part of a lawsuit, or you're out on an audit and you find these problems. There's no guarantee, like with a background check, you will catch all of that. But you want to try to mitigate any kind of surprises once you sign those to the audit. And then obviously things like HR practices, engagement performance. I talked about the whole idea of quality control. Peer reviews, quality control reviews, and that goes in as well with monitoring of the engagement. I already talked about peer reviews, so let me go into that in more detail. I'll give you an example of that. Just want to say a quick bring back, because this is such a significant change to the auditing profession, is the PCAOB. And considering that all of the major public accounting firms, they're inspected by the PCAOB every single year. PCAOB probably never leaves them. Right? So the requirement is that firms auditing greater than 100 public entities, they're audited by the PCAOB or inspected by the PCAOB on an annual basis. If it's less than or equal to 100, you can be audited at least once every 3 years. So at least once, but you could be audited more than once. And so what they're looking for is to identify deficiencies in the audit. The PCAOB's overarching goal is improving audit quality and the financial reporting quality as well. Information is reported to the public. I have this up in the syllabus of the PCAOB website, but you can go on the PCAOB's website and look at examples of their inspection reports. And it's a huge change for auditing firms. So the CAQ, Center for Audit Quality, has a guide that they put out, a guide to PCAOB inspections. And some of the points that they highlight, you can actually find this more detailed discussion of this on the CAQ's website, or find the guide on the PCAOB's website. I'm sorry, the CAQ's website. So the things that they focus on in their inspections or highlight are the importance of audit work papers. And why would audit work papers be important? That's where you document what you've done. So you can't have something and say, oh, I did it and I didn't put it down, because the PCAOB comes in and it's not in the work papers and you didn't do it. How did that? That's their way of determining the quality of the work, or even how you reach decisions. The documentation is important. They also focus on, explaining what happens if the PCAOB believes that there are audit deficiencies. And basically, when you have an audit deficiency, because the PCAOB believes that the audit did not comply with auditing standards. Right? So when they have that, or auditors' opinions, the opinion that they're giving on the financial statements is not supported by the work that they've documented in their audit work papers. The evidence doesn't support the opinion. So when that happens, they will communicate with the auditing firm first. And then the auditing firm has an opportunity to respond to it. The PCAOB's concern, and then the PCAOB will then determine if they're satisfied with it, then the deficiency is addressed. But if they're not, then they will put it in highlight it in the inspection report. They always, again, we get back to auditor judgment. The PCAOB expects that the auditor has supporting documentation to support their judgment. So if you remember, when we talk about judgment most times, because where we see the more difficult judgment is where there's uncertainty and risk. And the PCAOB's inspection process is risk-based as well. So by its nature, they're choosing the more difficult audits. The audits where there is probably a significant level of judgment, of subjectivity and complexity. So those audits are difficult just by that. So you're starting off with a situation where they're looking at your riskiest audit clients. So that, and judgment is always important to document, but of course, that makes it even more important. They also talk about in this guide the difference between inspections and enforcement proceedings. So an inspection is, when the PCAOB comes in and they're auditing or reviewing the work that the auditor has done for that particular client. And if they feel that it's a serious enough violation has occurred, then they're going to refer that to a hearing officer, and it could result in the firm receiving fines, suspensions, or permanent ban from public company audit, meaning that they would not be allowed to audit publicly held companies. So it's pretty serious. I haven't seen this for any of the big four or any of the major firms where they've been banned from being able to practice public, to be able to audit a public company. I have seen with the SEC where you've seen individual partners being banned, and it could be the case with PCAOB. I haven't seen it, where you've seen individual partners being banned or suspended for a period of time from auditing publicly held companies. So that's not, that's never ever going to form audit firms. All right, any questions about the professional standards? So, Module B, what's important to take away with the professional standards, just as you're preparing yourself for quizzes and exams, is knowing what each aspect of those three areas of the professional standards, understand what they represent. Right? And if you understand what they represent, what it means by responsibilities, what are the standards trying to dictate with respect to performance or reporting. And I'm not so much interested in memorizing standards. I want to make sure that you understand the standards. So we're going to spend a lot more time talking about independence. I'm just going to introduce it today, and then we'll finish it up on Tuesday. Rule 101. So I know in Module B, in Module B, we're going to cover a lot of standards that are covered. For our purposes, I'm going to focus on Rule 101 and Rule 102. That's where we're going to spend. So I don't expect you to memorize all of the standards. So I just want what is really important. What I'm going to focus on, as I said, is independence, Rule 101, and objectivity and integrity, Rules 102. So that's where you want to really make sure you understand those two standards. So, auditor independence. So, the way to think about auditor independence, because the problem an auditor runs into a problem where their independence is impaired. So they should be guarding against anything that would result in impairment of independence. So this is an academic article that describes auditor independence as the probability that the auditor will report an error in the financial statements or misstatement in the financial statements, given that he or she has discovered it. So we can talk about, we'll talk about when we talk about audit evidence and audit procedures, about if auditors haven't designed their auditing procedures effectively, they might not discover an error. So if you don't discover it, like if you never caught it, you have to look at whether or not the auditor is negligent or the auditor had, just didn't have the experience, and so they missed it. We talk about that. But if you didn't discover it, you're not impairing your independence because you missed something, right? Because if your independence impairment implies that you did not approach the audit with an unbiased, objective, manner, right? So if you missed something, maybe you were negligent or maybe you're just inexperienced, but you haven't violated your independence if you didn't find something. But if you missed something, you didn't violate your independence. It's when you know you find something and you don't report it. That's when you have impaired your independence. If you find something, you discovered it, and you don't report it. Or if you side with the client on something and all evidence would suggest, or you can't confidently explain why you're siding with the client's position. If evidence suggests, if a reasonable auditor would have come up with something totally different than the client's position. If you can't support your position and you side with the client and you can't come up with a good reason as to why you are siding with the client, other than the client told you so, that's probably going to be seen as an independence impairment. So let's go from that definition of independence. So there are SEC and PCAOB independence reporting rules. And the auditor's independence depends on having both, being able to pass both of these, right? Independence in fact and independence in appearance. Independence in appearance can be measured, right? That's why independence in appearance, because we can see, if we can judge whether an auditor, we can more objectively judge whether or not an auditor impaired their independence when we talk about independence and appearance, right? Because independence and appearance is based on Rule 101, which we'll get into. We'll go in more detail in Rule 101 on the requirements under Rule 101 on Tuesday, right? That's what independence and appearance is. Rule 101. So I can look at it and say, oh, this auditor violated their independence because her spouse is the CFO. She should not be the partner in charge of that audit. She should not be on this audit engagement, right? I can look and think it's easy to determine. Independence in fact, or also known as independence in attitude, independence in mind, is a mental state of objectivity. That's harder. Because I can't get inside your head. You know exactly what you did, why you made the decision that you made. The only thing I can look at is the outcome of that decision and look at the basis for your decision. And I might be able to conclude that you violated. If you can't support your decision, or if facts would suggest otherwise, and an outcome different than what you came up with, then I could proceed based on factors that you might have been impaired your independence in mental attitude, that you were not independent in fact, that you were biased in making that decision, biased toward the client. So we'll talk about, when we talk about Rule 101, some of the things that the Rule 101 prohibits, or the SEC as well, is certain types of consulting services that audit firms cannot perform for their clients, because you want to guard against auditors impairing their independence, that they're biased because they have economic incentives to report consistent with the client's objective. So that's why we have certain prohibitions in Rule 101. So make sure, important, understand the difference between these two. This one is very objective. Independence and appearance is extremely objective, right? That's what Rule 101, all the things that Rule 101 says you can and cannot do. This is much more difficult. And this tends to be one thing that's one that gets into trouble. Right? This is the one that tends to get harder. And more calm, it wasn't because of based on the auditor's actions and decisions that the regulators concluded that they impaired their independence and that in fact that they had an economic bond with their client. And so if you think about the nature of auditing, right, the client hires us, right? Hires auditors, right? They're not hired by the capital markets. You know, that's been thrown out there some as a possible solution, but it didn't happen. So one of the things another thing that Sarbanes-Oxley did, enacted as a result of the breakdown because of the WorldComs and Enron, was they made the audit committee more responsible. They required the audit committee to be more accountable than they had been. So now the audit committees have to hire the auditors. Now we can argue, some have argued that they're just rubber stamping management, but the bottom line is they have the fiduciary responsibility to the shareholders to do that job and do it effectively. They're on the hook because they're responsible for hiring the auditors. The thought process there is that if management is removed from that decision process, then auditors won't feel beholden to management to get the engagement or keep the engagement. That the audit committee, as a part of the board of directors, is the corporate governance, a form of corporate governance that helps to ensure that management is acting in the best interest of the firm, and auditors are acting in the best interest of the capital markets in terms of the judgments and decisions that they make. So that is one where that again, because this is so difficult to legislate, let's try to put in reforms and mechanisms that will make it more difficult for auditors to impair their independence in their life. So let's leave it here. We'll pick up, finish up independence on Tuesday.